Bruce Hardy, and I am here today to present to you September 2025's to the industry. So let's take a look at some of the factors that impact real estate. But before we do, I need to cover our disclaimers. One is anything we share with you here, please be aware of the TCPA, the Telephone Consumer Protection Act, which actually forbids you from calling people on the do not call list. So I encourage you to make sure that everybody you call, you're scrubbing those numbers against the do not call list. I also want to make mention that this is information for information purposes only. We make no warranties or guarantees. And secondly, all commissions are negotiable. So we're not setting any commissions, whether by law or by practice. And finally, AI and the Can Spam Act, you need to be very aware of. Now, let's take a look at some of the key factors that impact the economy of the United States. Now, one way to look at our economy is all of these variable features that actually impact each other. So if we look over here on the left-hand side of your screen, you see government policy and the certainty around that. And by the way, that directly impacts the cost of money. So the interest rates that are being charged and what it costs to borrow money. Now, the GDP, or the gross domestic product, actually are impacted by tariffs. Now, the challenge that we have in the world that we live in today, all of these things will impact inflation and unemployment. Now, in a market, typically what we see is when inflation goes up, unemployment goes down. When unemployment goes up, inflation goes down. And you're going to see here in a moment that we're in a very unique time where we're seeing both unemployment going up, as is inflation. Now, the challenge with that is that now the Fed has to pick their poison. And what I mean by that is they have to pick what they are going to focus on, whether it be, are we going to try and improve unemployment, right? So put more people to work, or are we going to stay focused on inflation? Now, by the way they deal with those two problems are exactly the opposite. So, for example, if they want to improve unemployment, they're actually going to lower interest rates so that businesses borrow more money and look to expand, and consequently they hire more people. If, on the other hand, they're looking to combat inflation, then the idea is they raise interest rates, which slow down spending, which then lowers the inflation rate. So again, interesting times, and we'll talk more about this as we go through this presentation. Now, this is not a political statement, but this is really how politics and policy making works. Each of the parties, whether you're Republican or Democrat, I'm not making a statement one way or another here, but they have an ideology, and that ideology actually influences the policies that they put into place. Now, you can see here that social policies are how you get elected. What the policies you put in place that take care of the people cause the people typically to want to vote for you. Now, by the way, foreign policy, how we behave, how we lead on the world stage, will ultimately be a predictor of how we get reelected. And then economic policy can actually get you unelected. And what I mean by that is if you enact economic policy that is not favorable to the populace or actually deemed favorable, then more than likely you'll get voted out. That's the reality of our political system. So understand that each of the parties are ultimately looking at these three facets as they think about their ideology and the policies that they set in place. Now, there are three key indicators that actually impact our economy and ultimately real estate. The first one is unemployment. Now, the goal of the government is to have unemployment under 6%, because under 6%, it's at a manageable level and the populace feels good about how the economy is going. Now, you can see here that other than in 2020, when we had that spike because of COVID, you have to go all the way back to 2014 to have unemployment above that 6% rate. Now, by the way, you can see that we've had historic lows going all the way back to 1990. You can see that 2022 and 2023, 3.6% unemployment. And basically what we had there was everybody who wanted a job had a job. So for all intents and purposes, we're fully employed. Now you can see that things have been trending up. 24, we bumped to 4%, and we're projecting this year to be 4.5%. Now, if we look at what's going on month by month, you can see here that we're now starting to slowly see that increase in unemployment. And in fact, the numbers just came out for the month of August, and they came in at 4.3%, which was right on target with where the economists were projecting. Now, what we see here is unemployment versus job openings. Now, you can see here the light blue line is unemployed people in millions, and the yellow line is job openings. So what you see here is that we had, for a period of time, pretty much from 2021 through to about now, where we actually had more jobs available than we had people to fill those jobs. Now, what does that mean? Well, typically it means that salaries will go up because it's supply and demand. Employers want the best employees, and when there's a shortage of great employees, what do? They offer more money. And you can see now that we're on a trajectory where the number of unemployed people are actually going to start to exceed the number of job openings. And again, the last time that we really saw this was back after the during the Great Recession back in 2009, which was where it was greatest. So we need to keep an eye on this unemployment. Now, you can see here unemployment by state. In the West, in the Northwest specifically, Idaho is at 3.7% unemployment, so below the national average. Washington came in actually at 4.2% unemployment in June, which was at the time right at the national average. And you can see Oregon is a darker color, and that's because Oregon came in at 5% unemployment. And along with California and Nevada, those states are seeing a higher rate of unemployment in the current market. Now, the next key number we look at is GDP, and that's gross domestic product. And what you see here is the annual GDP numbers, and in 2024, we had growth of 2.8%. Now, the number that the Fed and the government is looking for is an average rate of around 2%. If we have a gross domestic product growth of around 2%, what that means is that the economy is doing really well and everybody's on fire. Now, you get over 2%, and it's basically champagne and cocaine. The market's humming until, of course, you see it get really high, like we did back in 2021, where now it's on fire. Now, by the way, by definition, the government has said that a recession is any 2 consecutive quarters with negative GDP growth. So this is the annual numbers. You can see we had negative growth in 2009. We had negative growth in 2020. Now, if we look at the quarterly, you see what happened here. So the first and second quarter of 2020, we had negative growth. Why? COVID, right? We locked the country down. We weren't producing as much. We weren't spending as much. We weren't importing as much. Then we had a massive comeback right after the country reopened. Now, we had 2 quarters of negative growth in 2022, but the government said, that's not really a recession. Well, okay, it's your definition. Fair enough. Now, if we look at what's going on this year, though, first quarter, and these numbers get revised multiple times. You can see here that we're now currently a revised number of a negative 0.5% growth. And again, we have to dig a little deeper to actually understand what's going on here. The first quarter, what we saw was a massive influx of imports. Now, by the way, one of the ways that they actually measure GDP is by looking at the number of imports versus the number of exports. Now, the reason that we had a massive number of imports in the first quarter was a lot of retailers were actually looking to get ahead of the tariffs that were being threatened. And so they imported extra product. And then we saw in the second quarter, those imports slow down because everybody had warehouses full of product. And by the way, that's why you see our growth at 3.3%. So unfortunately, the GDP and the impacts of tariffs on our gross domestic product won't really show up until the third and fourth quarter, but we'll keep an eye on that. Now, the third key metric is inflation. And of course, this is the one that we hear a lot of conversation around. And I would tell you, quite frankly, inflation is one of the greatest risks to a democratic society. And the reason for that is that when we see inflation go up at a very quick and high rate, what we see is there are those that have and those that have not. And those that have a very different experience in a highly inflationary market. So if you look over the last few years and you take the top 1% wealthiest people in this country, have they actually been harmed by high inflation? And the answer is no. I mean, they don't care that a dozen eggs cost $6. But what has happened for them is all of their assets have increased in value. So they've actually made more money disproportionately to the rest of the population. And in fact, that's why you saw the Fed react so quickly when we saw rates spike up just over 7%. In fact, we saw the rates go, the federal funds rate, which by the way is the rate that banks borrow money from each other, it's an overnight rate, went from 0 to between 5.25% and 5.5%. Now, once we saw that happen, the Fed raised the rate quickly, and then we saw the brakes go on inflation, and it started to drop dramatically. And now it's sort of gotten down into a range where it's being a little bit stubborn. And you can see here what's happening on a month-to-month basis. Now, in July, you saw that in CPI, Consumer Price Index, which is a measure of inflation, actually stayed level at 2.7%. However, core CPI, which is the consumer price index with energy and food stripped out. And the reason they do that, by the way, is because of the volatility. For example, if there's a hurricane in the Gulf, what happens to the price of gas? Well, it goes up. Why? Because refineries shut down and there is a limitation on supply and demand drives prices up. If there's a flood in the San Joaquin Valley in California, guess what? The price of produce goes up dramatically. So they strip those out to try and get a better feel for what's going on in the market. And you can see here that core CPI in July went up 3.1%, which was an increase from 2.9% back in June. Now, by the way, 40% of the calculation of this inflationary number, Consumer Price Index, was actually driven by housing cost. Now, when they're measuring housing costs, they're not just measuring the cost of buying a house, right, so prices of houses, or the cost of the mortgage, right, the interest rate. It's also rents, which are a big part of that. So you can tell that we're actually still seeing the pressure of real estate, and the cost of owning or renting housing is driving inflation up. So again, something to keep an eye on. Now, one of the challenges we have in our country, and this is not the government's debt, but this is the debt of our people. Now, we have 13.35 trillion in mortgage debt, all-time high. Now, I would tell you quite frankly, I believe that that's not necessarily an issue for our country, and the reason is that debt is secured by real estate. And not only is it secured by real estate, but it's now secured by the most valuable real estate has ever been in this country. In fact, we have record levels of equity available to owners of real estate. Now, the one below, though, is non-mortgage debt. And you can see we're currently, as a society, as a nation, carrying just over 5 trillion in non-mortgage debt. Now, that non-mortgage debt is broken up into these 4 categories. Number one, the highest debt we have right now is actually auto loans, and that's coming in at 1.66 trillion. The second highest debt is student loans at 1.64 trillion. Now, if you look at this graph, what you'll notice is that the vast majority of this debt has actually been accumulated literally in the last 10 to 12 to 13 years. So if you take that into consideration, what you understand is that the average age of this group are people in their 30s. Now, why does that matter? Well, this debt becomes burdensome when people are trying to save for a down payment to buy a home. In fact, last year, for the first time, we had a record high average first-time home buyer age of 38 years old. I believe the student debt is a big part of the reason for that. So again, getting control of the student debt is going to be an interesting challenge for our country. Now, the pink magenta line here is credit card debt. Now, in November of last year, for the very first time, we cracked $1 trillion in credit card debt. And you can see that currently we are now at 1.21 trillion. Now, what's significant about this is that credit card interest rates are actually tied to the federal funds rate. Now, the federal funds rate is what dictates it. And if we look at credit cards today, the average credit card rate is actually 26%. Now, if you look at the average balance of those people who don't pay their credit cards off each month, that average balance is $5,200. Now, by the way, if those people were to stop spending, cut up their credit cards, and make the minimum payment on those credit cards at a 26% interest rate with a minimum payment, it's going to take them 17 and a half years to pay that debt off. So again, this is a little concerning, particularly because the rates are so high. And then, of course, what we have is everything else, right? There in the blue line, and you can see that's been fairly steady. Now, if we look at what's going on with delinquencies on repayments of those loans. Now, this is the latest data from the New York Fed showing the number of loans and the percentage of loans that are in a 90-day plus delinquent state. Now, what I want to point out is that people are making their mortgage payments. We're not seeing massive foreclosures. People are making payments on their HELOCs, right? The home equity lines of credit. For the most part, people are still making payments on their cars, although we're up near the levels of where it was back in the Great Recession, where people were letting go of unable to make their car loans and letting those cars go. Now, the ones that to me are most troubling is one, we've seen student loans now go into 90-day plus. That's risen 10% of all of them are in 90-day plus delinquent states. And we're beginning to see credit cards going into that same state, which showing that there is some stress on the consumer around making payments on all of these opportunities. The flip side of the debt, of course, is personal savings. What you see here is personal savings as a percentage of disposable income. Now, this graph goes all the way back to 1947, and you can see even though we've seen a slight increase in the percentage of personal savings at 4.6%, if you look historically, we are down in similar levels of savings as we saw back in the Great Recession. So again, the reason we want to take a look at this is because it's important that consumers save money because they need the down payment, right? So they can get into their houses. Now, just a sidebar here, what you see is this massive spike back in 2020. Well, what happened here? Well, one, we saw the savings rate go up because of COVID. Everyone was locked down. They weren't out spending money. In fact, they were saving it. And then because the government didn't know quite how to handle a pandemic, they started flooding the market with money. And that's what raised that rate. It was short-lived, however, and you can see where we are today. Now, if we get into real estate, we look at home sales. And what you can see here is the annual sales rate. So this is the number of single-family homes sold each year going back to 1990. Now, the pink dotted line that goes across the screen here is actually 4 million. And if you look here, over the last 2 years, we came in at just under 4.1 million. Now, by the way, if you look back, when was the last time? In fact, 2024, it's a rounding up to 4.1. We actually did 4.06 million homes sold. And the last time we did a number that low was 1995. And in fact, in 1995, there were 70 million less people in this country than there are today. Now, the forecast is that we're going to close about 4.2 million homes this year. Now, when you look back to 2021, where we closed 6.1 million, and then in the space of 2 years dropped to 4.1 million, what I want to say is that the real estate industry is in recession. When you see a 30% drop like that, that's a recession. Now, the good news for us is the last time we saw that was during the Great Recession back in 06, 07, 08. And yet the difference this time around is the economy is not in recession, which it was back then. So things don't feel quite as bad, but they do feel a little wonky. Now, when I say that and I use the dreaded R word, I don't want that to scare you. Right? Understand that last year we closed almost 8.2 million homes sides. So 4.1 million homes represents 8.2 million sides. So the question you have to ask yourself is how many sides do you need in order for you to hit your financial goals? Because whatever the number you tell me, the market is delivering them. Now, real estate's an equal opportunity business. It's just unequal rewards. And what I mean by that is everybody has the same opportunity. Not everybody makes the same amount of money, but the opportunity is there. Now, when we look at home sales, what you see here, reset. Now, this is another graphic that just shows you what home sales have looked like going all the way back to 1969. Now, you can see here that we've literally had 2 years of flat growth, if you can call it growth. It's not, but it's flat. And 2025 is probably going to be fairly similar. The economists that I follow believe that we're going to see 26 being very similar before we see the recovery occur in 2027. Now, but again, the reason I have the dotted line here is because it looks like now 4 million is probably the floor in terms of the number of home sales annually in this country. And that's just simply a result of the population we have in this country. Now, there are things that drive real estate regardless of interest rates, regardless of the economics, regardless of, for example, low interest rates and being rate locked. There are reasons, right? There's death, divorce, debt, diapers, and Democrats. Now, they're what I call the 6Ds. Actually, I missed one, and that is the job. So death, divorce, debt, the job, diapers, and Democrats. Again, not a political statement, but what I would tell you is in my 31 years selling real estate, I've never seen people move from a blue state to a red state or from a red state to a blue state because of political leanings, like I have in literally the last 4 to 5 years. So that is impacting people moving. So if you think about all of those, death, divorce, debt, the job, diapers, and politics, I had to say Democrats, otherwise it wouldn't be a D. And what you see here is all of those cause a real estate transaction to happen, regardless of what's going on in the economy. So the opportunity will be there. And because we have so many people, we're going to have 4,000 transactions. We're going to have 4 million transactions annually anyway. Now, if we look at what's going on monthly, you can see here, and this is over the last 4 years. Now, I want to bring your attention to the graph here in the top right-hand corner. And that is the seasonal sales cycle or seasonal income cycle of real estate. Now, it doesn't matter, and I have the opportunity to teach all over the country, but it doesn't matter where in the country I go. We've always traditionally seen the first quarter of the year, January, February, March, being the slowest time. And then the spring market kicks into gear, and we see the second and third quarter of the year is when we do our most sales, right? So we would call it the summer market. And then as we go in the third quarter, we start to see it taper off, and then we see a drop into the fourth quarter, usually a pickup in the month of December. And that's typically the builders as they're trying to get their product closed prior to the end of the year. Now, if this is the normal income cycle, how does that graph compare to the colored graph you see here? And of course, the answer is it doesn't. So what we've seen on a national scale is seasonality has gone out of the market. Now, I will tell you at the local level, that's not the case. Now, we are looking currently at the national numbers. Now, that's a little bit like me being a meteorologist saying the average temperature in the United States today is 74 degrees. Now, that may have very little bearing on where you are and what you're experiencing right now. We know real estate is a local business done by local realtors with their sphere of influence and their marketing image. But the key is we need to see what are the macro indicators that actually drive our micro market. And so that's why we're looking at these national numbers first, and then we're going to take a closer look at what's happening here locally. Now, if you look at this, what you'll notice is the green column is 2025. And other than January, where we saw a slight uptick versus 2024, February was down, March was down, April was down, May was down, June we saw a very slight uptick, and July we saw a slight uptick as well. We are on track right now to do about 4 million homes, 4 to 4.1 million homes this year, based on the current numbers, unless, of course, something dramatic happens. And, the crystal ball gets a little foggy after tomorrow. Now, if we look at this, and this graph to me is so powerful because what this graph says to me is it's always a great time to buy the right real estate. Now, what you see here is the median home price of residential real estate every year from 1990 on. Now, the light blue line that you see there is what we call the trend line. Now, historically, residential real estate in the United States has appreciated by 4% per year. That's what that green line represents. So each year, if real estate is going up 4%, it would be matching that line. And you can see from this graph that all through the 90s, we were actually tracking perfectly along with that line. And then in 2001, we bumped above it. And by the way, by 2006, we were actually, house prices were 21% above where they should be. Now, did it feel like they were overpriced in 2006? Well, certainly at the time it did. Now you say, well, why were they so much higher? Well, for those of you who are old enough to remember, it was during the financial crisis where we were giving away money like there was no tomorrow. In fact, if you could fog a mirror, you could get a loan. And it was the subprime lending which actually drove it. Everybody said they were a real estate investor, when in actuality, most of them were actually speculators. Now, what happened was the wheels fell off the bus, and we saw things crash, right? And it tumbled dramatically from 2006 through 2008. And actually, it hit the bottom in 2011. Now, again, for those who were in the business back in those days, 2008 onwards, what we saw was a proliferation of REO properties and of short sales. So that was where we saw it. And we saw prices come down. And then we saw this gradual appreciation. And you can look, it actually paralleled along the 4% line. It was just lower. And in fact, many economists thought that maybe we needed to drop that line back down to actually match where the market was. However, take a look at what happened in 2021. We saw a dramatic increase in transactions, 6.1 million home sales, and we saw prices go up dramatically. Last year, we were 9.9% above where we should have been anyway if we'd been following the 4% trend line. And based on forecasts this year, it's predicted we're going to end at 8.3% above the trend line. So historically speaking, prices are not that far out of where they would normally be in today's market. Now, my question to you is, do you wish you'd bought more homes in 2006 that you still own today? Well, I hope the answer is yes. And the reason why is, look, even though you would have paid above market at that time, if you'd hung on to that real estate today, it would have been worth way more. In fact, it only took until 2015 for you to get back to where you were at par at the same value. So again, it's always a great time to buy the right real estate. Now, trying to time the market, that's where people get into trouble. Now, the other big question that we've had is inventory, and that's been a challenge for us. Now, this blue dotted line here represents 6 months worth of inventory, and that has been what we traditionally considered to be a balanced market at 6 months worth of inventory. Now, pretty much all the way back to 2012, we have been below that. Now, anything below 6 months of inventory is generally considered a seller's market. And then anything above 6 months would be considered a buyer's market. Now, what causes those is a seller's market is when we have less inventory and more demand. So we have more buyers in the market and fewer homes sold. And by the way, which is what we've experienced for the last 5 years, where people have had multiple offer situations, the prices of homes are being bid up. That's what's helping to drive prices. Versus what happened back in the 2008 and onward, what we saw there was we had a massive amount of inventory and nobody buying. And that's what actually drove prices down. So again, you can see here, we have been in what has been a historically seller's market. Now, with that being said, here's what's going on a monthly basis. And you can see that in July, in fact, we saw inventory drop slightly from June to having 4.6 months worth of inventory. Now, I gave you that general terminology there of a buyer's market and a seller's market. However, could we both agree that you could have both a buyer's market in one price range and a seller's market in another price range occurring at the same time in the same marketplace? And of course, that's the truth. So we all have that, and we'll see that showing up in different markets and different price points. Again, looking back at this, we're the highest amounts of inventory that we've had in 4 years, which, by the way, seems like a lot. But again, historically, it's not necessarily a lot. Now, home starts. This is another challenge for us as an industry because, we need the new construction industry to build, on average, 1 million homes a year to satisfy the needs of our population. And that's what the dotted line is across the screen. Now, we were actually building in excess of that prior to the Great Recession, right? And the reason was there was so much speculation. People were buying new houses and the builders were going gangbusters. And then along came the crash. And what happened? Well, a lot of small and medium-sized builders actually went broke and got out of the business. A lot of really good people got hurt back in those days. A lot of the big builders scaled back their businesses and looked to survive. So you can see that for basically from 2008 through 2019, an 11-year period, we actually had a shortfall of new home starts. And since then, we're bouncing right around the million mark, but we're not building enough to make up for that shortfall. So again, that's a challenge going forward for us as an industry. Now, you can see here's what's going on a monthly basis. And again, we're not seeing any dramatic increase in housing starts. Mortgage rates. Now, what I love about this graphic here is that it gives us perspective. In fact, if you look all the way back to 1972 to today, the average mortgage rate over that period of time has been 7.72%. If we go back to 1990, so we take out the highly inflationary period of the 80s, and by the way, people bought and sold houses back here when interest rates were at 16, actually were higher than that. They were even as high as 18.5%. This is an annualized number. But if we take that out, you can still see that the average interest rate was 6%. Now, some of us who are too young think that the 3% rates that we saw, or sub 3% rates we saw, which were a result of the Fed lowering interest rates to zero to try and stimulate the economy after the pandemic, those were not natural. And I believe that we're getting past that now, and people aren't saying, well, I'm waiting for rates to come back down. And the question we also have to ask ourselves, what has to happen in order for us to see a dramatic drop in interest rates? Well, be careful what you wish for, because in order for us to see rates go down dramatically, we're probably going to have a recession. Other than that, there is no reason for them to lower the rates. Now, and you can see here's what's been happening on a monthly basis. And now we're just bouncing along, and this may be our new normal for a time. Now, here's the other challenge that we have as an industry, and I know I'm sharing a lot of challenges, but I'm going to share with you the bright points, right? The high points, and how you get to actually not only survive in this market, but thrive in this market. But first, let's look at affordability. And you can see here in 2024, it actually took, when they measure affordability, they're looking at what is the median income and what is the median home price, and what percentage of the median income does it take to buy and own a home. And you can see here in 2024, we came in at 33%. Now, by the way, going back to 2006, when prices were 21% above where they should be, affordability was at 32%. Now, what was driving that? Well, that was simply prices. Now, if we go all the way back to 1991, it actually took 49% of the median income to purchase the median priced house. Why? Because interest rates were at 17 to 18%. Now, if we look over the last 20 years here, right, you see that we actually got down in 2012 to 17%. So it only costs 17% of the median income in order to purchase the median priced house. Why did that happen? It's because we saw prices plummet, because a lot of it was REO and short sale. By the way, in 2020, it only took 18% of the median income to purchase the median priced house. Why? Because interest rates were at 3%. So what really impacts affordability here is interest rates and prices. So if we have prices go up, and by the way, interest rates go up, affordability goes down and becomes less affordable. If we see interest rates go down, affordability becomes better. If we see prices come down, affordability becomes better. So again, interesting times we're in. It looks like it's correcting. We'll keep our fingers crossed. Now, with all of that being said, this is the volume per agent each year. Now, what you see here is, and by the way, I think we can all agree that as realtors, we actually get paid on volume, not on units. Now, even though units are down, our volume, in fact, we're projecting this year to be the third highest volume per agent of any year. Why? Because the cost of housing has gone up. So the opportunity there is for you to make as much or more money than you've ever made this year if you're in the right place at the right time. And what I mean by that is getting in front of the consumer before they make the decision to buy or sell a home. So again, the good news is the volume is still there, even though the unit count is down. Now, The challenge with that, of course, is there's more realtors than there are deals. And so consequently, you've got to go out and get your unfair share of those transactions. Now, I also want to share with you, and that is this data is from the National Association of Realtors. And what this shares is the fact that the consumer still wants to work with a realtor. And this is the buy side. And you can see here that we've been at 88% pretty much consistently for the last 15 years. In a market where you would argue that, oh, the internet's out there, there's AI, there's more information available, that buyers could actually get the information from us and theoretically could buy a home without us. And yet you see here, the data is proving that they still value us. In fact, 88% bought through a realtor, 5% bought directly from a builder or a builder's rep, and 7% bought from for sale by owners. So they are actually valuing us. Now, I would tell you, I believe the industry changed fundamentally when the internet came into play in about 95, 90. In fact, prior to the internet becoming a player, our model was that of the gatekeeper. And what I mean by that is if you wanted to buy or sell real estate, you had to come to a realtor because we had all the information. We locked it up in this thing called a multiple listing service. Now, we let the internet in and basically that horse bolted out of the barn. That information is out there. Our model has changed, and it's changed from being fundamentally a gatekeeper of the knowledge to being a service-based industry, where we're here to serve our clients and help them get their dream home or help them get their home sold. And we are very good at doing both those things. Now, I thought this was interesting, and this was some research that we did as a company. And this is what buyers say they would prefer in the home buying process. So what you see here is 48% said they would prefer a person in finding a home. That doesn't surprise. In fact, what's surprising to me is it's only 48%. And the reason that it's only 48% is because 23%, they said they would trust an AI tool to help them go find the house. And 29% is that they would trust both equally. Now, why is this important? Well, I believe it's important because if you as a realtor are not embracing AI and harnessing it as a tool to help you in your business, you're going to get left behind. You're not going to be replaced by AI, but what you will be replaced by are other agents who use AI. So AI, you can see it here in whether it's finding a mortgage, insurance, or legal assistance, it is an important component. And then finally, we asked what's most important to buyers when working with professionals. And I thought this was fascinating. And that is 80% of respondents said comfort was most important for them. So let me ask you, is it a comfortable experience for both buyers or sellers to work with you? Do you make it easy for them? Now, by the way, convenience, right? And I think this is really interesting, right? Where realtors think they have to answer the phone 24/7. Do you think your consumer wants you to be on the phone available for them 24/7? And I would argue no, they understand we have lives too. But what they do want is information. So how do we harness AI? How do we harness the technology that allows us to be of 24/7 service and provide that convenience and yet be able to balance our lives as well? So again, thinking about this, how does providing a comfort or rather a comfortable experience for your consumer show up in your business? And are you actually even thinking about that? Now, one other thing is, again, I bring this up because AI is revolutionizing our industry. And the key about it is it's happening very quickly. Now, if you are not plugging into AI training, you haven't missed the boat yet, but you need to get on board because it will be leaving soon. And what this graphic shows you is the amount of money invested in today's dollars each year. So back in 1995, right, which is when the internet sort of started to explode, you can see the amount of money invested in development on the internet in today's dollars over the next 8 years. And then, oh, by the way, look at that for AI. How much money is being invested in artificial intelligence in an 8-year period? Now, of course, the statement on the screen here, investment creates value, speculation creates bubbles. And this is the story of adoption that we get. We call this the S-curve. And typically what happens is people overestimate the short-term impact of technological innovation and they under expect what the long-term impact is going to be. So if you look at this right now on the news, AI is everything everywhere. In fact, everyone's branding themselves as an AI company. Now, will all of those AI companies survive? And the reality is no. So are we going to experience a bubble that may burst and we'll see businesses go out of business? In fact, that's what the turning point is there in the dotted line, is you will see businesses fail. But however, what will happen is those that have actually nailed it and understood how to utilize AI, they will continue on and they will gain adoption, which will then take them to maturity. So again, be aware, there are lots of choices out there. I really encourage you to plug in. Now, what I want to do is we are going to take a look at what's happening locally in this market. As I mentioned earlier, real estate's a local service business done by local realtors with their sphere of influence and their marketing image. So with that in mind, let's take a look at what's been taking place here in the Valley in Yakima. First thing I want to look at is what's going on with the median price. Now, the red columns that you see here represent the active listings. The blue columns is under contract and the greens are the solds. Now, this is looking at 2 years worth of data, and I'm comparing last month, that'd be August, with August from 2024. Now, what you see here is a mixed bag. We're seeing that the median price of the active listings is up just over 15,000, with a median active list price of 400,495. The under contracts are actually down 10,000 at 349.9, and we saw just a bare increase in the median price of the solds at 371,500. So fairly flat. No real changes here, but we're not seeing markets drop in price, and we're not seeing dramatic increases in price. Now, if we look at the seasonality, or rather the supply and demand, and then the seasonality of that, you can see it here. It shows very well. December, January tend to be the quieter months, and February. And of course, the summer months tend to be. Now, this summer, across all three metrics, we're seeing things stronger, which is awesome news. In fact, you can see here 788 active listings in Yakima County. Now, by the way, these are just residential units, single family homes. So 788 homes for sale. And 182 went under contract, which is up 11% from a year ago, and 162% closed, and that's up nearly 9% from a year ago. Now, I want to be clear about this. The opportunity is there. So each one of these home sales represents two transaction sides. So, for example, if there's 162 homes have gone sold, that's 134 sides, which means that whatever your number is that you need to accomplish your goals in this market for this year, they're there. You just need to make sure that you're putting yourself in front of those opportunities. So again, looking good. Everything's up. We like that. Months supply of inventory has gone up just barely from 2.7 months of inventory to 3. So as a market as a whole, we are going to be seeing things still biased towards the sellers, and yet the buyers are getting more control and feeling like they are. So you're going to have to negotiate a little stronger. Our days on market have dropped dramatically. In fact, they've come down from 77 days on market to 43 days on market. And this is important to communicate to both sellers and buyers, right? And what are you doing? Are you changing up your communication plans? Are you being more attentive and looking at this as a shorter term opportunity? I hope this information was helpful. I'm providing this once a month. So if you've got any questions, concerns, or just anything regarding the market, please don't hesitate to reach out to us. I'll look forward to seeing you again this next month with the latest state of the industry. Have a great month. Bye now.